Thank you for coming. And today we have Sri. He is the managing director of BTVC. He leverages his background in engineering, law, and business to identify and analyze early stage companies for potential investment opportunities. He holds an MBA from Carnegie Mellon University's Tepper School of Business, a JD from the George Washington University Law School, a master's and bachelor's in electrical and computing engineering from CMU, as well as a bachelor's in cognitive science. So I'll let you get started.
Thank you very much. Hello, everyone. Before we jump into the lecture, all I'm going to ask is for people to ask as many questions as possible. It's a little bit of a dry topic and I'm not the best speaker. So if people ask questions, I'll know better where to put some time, some effort and explain things a little bit more deeper for things that are interesting rather than putting everyone to sleep. With that, I'll go ahead and start the presentation. So my name is Sreekar. As Allison mentioned, I am the managing director, or one of the managing directors of BTVC, which is a new venture capital fund here in Pittsburgh. For the last 18 years, Blue Tree has been an angel fund here in Pittsburgh, run by Catherine Mott. I've been with Blue Tree for the past 5 years, and we have been angel investors, really kind of focusing on early stage investing in companies that are, within 250 miles of Pittsburgh, and really focusing on professionalizing that asset class to try to work on bringing the best returns for our investors. And with that, I'm going to start talking about the role of angels in the capital formation or in the funding of a lot of these early stage companies. So the first thing is, who are angels and how are they different than venture capitalists? And I'm going to quickly go through kind of what they are, who they are. So it's individuals who themselves have been successful entrepreneurs or successful CEOs, people who are retired and who are looking to give back to the community and leverage their experiences, their knowledge, their skill set to help new companies or up and coming companies make the transition from startup to ongoing concerns. They are accredited investors. An accredited investor is a definition set by the SEC that says who is allowed to invest in early stage startup companies. Because of the high risk of these investments, because of the lack of knowledge about what's going on in the industry, the SEC and to an extent the IRS have said that only certain people in the US can invest in these companies, and that is people who are accredited or people who have more than a set amount of income, either 200,000 or 300,000 as a family, or have more than $1 million in assets. Basically, people who can make the risk to invest in these types of companies and who, if they lose their money, won't be too badly hurt by the loss of that capital, and who have the financial knowledge to understand how to make that assessment. Now, what's the difference between venture capital and angel investing? So in angel investing, angels are investing their own money. They're making the decisions about which companies get their money. In venture capital, the focus is on giving their money to a set of managers called general partners, who then make the decision about where the money goes. And so that's the big difference about what is the difference between an angel and a venture capitalist. Typically, but not always, angels are local. You can think a lot of the angels that invest in early stage companies are local, but you know of other angels who are not. Think of Mark Cuban or the people on Shark Tank. Those are all angels and investors as well. Now, the big key for angels and for venture capital is that they're investing in businesses that are not run by the family. And the reason for that is, more particularly than that, they're investing in businesses that are looking to get sold somewhere down the line. So angels, VC, early stage investors are putting money in, but they're not getting dividends, they're not getting interest, they're not getting any returns on their money until the company gets sold. So the big thing they want to do is see that the company is sold within 5 or 10 years. They don't want to see the company handed down to the next generation and the next generation and the next generation after that. And they are very active. The number of angels, as we'll see in some later slides, have grown tremendously over the years and are still growing. where do they fit kind of on the scale of where a company's exist in the lifetime of its growth from an idea all the way to a publicly traded company. Angels fit kind of in that early middle stage. So typically angels don't invest in just an idea. They need to see a product on the market, or at least a product that's ready to go to market. Typically the earlier investors are going to be friends and family or the founders themselves. But after they hit that stage, before they're ready to really reach out to venture capitalists, to others in the world, angels fill that gap of helping them take their idea, take their prototype and start to harden it a little bit, make it more commercially viable. Really work on the product design, really kind of help figure out where the product is going and get it to the start gate, at which point venture funds and other institutional investors can help the company with larger sums of money move forward in the progression of the company. And here's another way of seeing it. They're taking investments where the risk is relatively high and the market hasn't quite adopted the solution yet. And they're hoping that they're picking the right companies that will make that transition to where the risk comes down and the market really does adopt the solution. And that's always the hard part for angels, and it leads to a relatively high failure rate, which is built into the models for angels. And we'll talk about that in a little bit. Another way of looking kind of at some of the information on that earlier slide is kind of how much money is being invested at certain stages of a company, who's involved, and what kind of value that company is given. Another interesting thing about this is on the left half of this timeline, a lot of companies are valued. You'll see on the bottom, there's valuations of somewhere between 100K and 4 million. But the valuations aren't based on a lot of traditional metrics. It's normally by analyzing how much of the company the investors want to own after they make their investment to validate the risk, because there's likely very little revenue, so you can't do a revenue multiple. Likely the company is losing money, so you can't do an EBITDA multiple. So none of the traditional valuation metrics work. So it's very typically more on ownership stake than it is on how do you value the cash flows of the company. So how do angels decide which companies to invest? And while everyone makes their decisions differently, in talking to a bunch of angels, this is typically the way in which angels analyze their decision, which is first and foremost, it's the management team. Even before the product, before we worry about what it is we're investing, we need to know that the people who are leading the team are going to be able to take it and execute on their dream. All too often, you'll hear 100 good ideas. If you walk around CMU, if you walk around Pittsburgh, there are a lot of good ideas, and there have been for years. The thing that is really difficult is finding teams that can really execute on it and have what we like to call an unfair advantage, something that's special to them that'll allow them to succeed where no one else can succeed. Once we get past team, then we start to dig into the company itself. How big is the market? How mature is the market? Who are the other players in the market? How does this product affect or address a need in the market? And typically we want to see a unique way of addressing that need that someone else, a larger player in the market, couldn't just copy and steal from the company. We want to know kind of the product uniqueness, the technology that's being used. What's the technology stack? How does the solution really address that need? And what's the kind of unique perception that they bring to the table that's going to allow them to succeed where others have failed? And finally, at the end, once we've analyzed the company, the question is does the structure of this investment make sense for where the company is, how much money they need, and where they're going to as they get to exit? Now, as we said, the team is the most important. And so there's a lot of different things that are looked at by the team. First and foremost is the CEO, the person who's at the helm of the company. Are they coachable? And coachable means a lot of different things to different people. Everyone says the word coachable, and it's always very important. For us at Blue Tree, coachable is a balancing act of someone who is open enough to listen to our advice, and obstinate enough to hold on to their values when they believe that they're right. Because you don't want, for us, we don't want someone who's going to change their mind every time someone gives them more advice, nor do we want someone who's so stuck on their own belief that they're right that they're not willing to take the advice and experience of others who've been there before them. So it is a very hard balance to find. So once you get past who are angels, what are they investing in, or how are they investing in these companies? This has changed over time. Now, more recently, what we're seeing is angels are typically investing in rounds that look very similar to VC rounds. It's either a convertible note or a preferred round. So a convertible note is a debt instrument. It's a loan to the company, but instead of paying back the loan, it converts into equity somewhere down the road under certain terms that are very standard. A preferred round is investors are buying a portion of the company, and that portion is negotiated between the founders of the company and the angels. There are other typical things in an equity round. You're typically seeing liquidation preferences, typically 1x non-participating, which matches what the NVCA puts out as their typical terms. And what you'll see is angels are starting to adopt a lot of what the National Venture Capital Association is suggesting as good policies for early stage investing. And before I jump on, does anyone have any questions about the words up here? Because they're not standard words, but they are relatively important. Okay, we'll move on. And please, for those who arrived a little late, please interrupt me with questions. This can be very boring and very dry unless I know what people really want to hear about.
Yeah, I got a quick question regarding the last slide about the board seat. Is it common for like early angel to have a board seat?
Not common, especially so. In a typical round, what we see is the boards are typically allocated once you get to a preferred equity round. So when there's preferred stock, a lot of early angels enter in what's called a convertible note. The note is a debt instrument that doesn't have ownership stakes in the company yet, and as such, typically doesn't have board seats. What we are seeing though is that some angels, especially the more sophisticated ones, even at the earliest stages, are asking for a board seat or an advisory position to help advise the company, because they want to make sure that once they give money to the company, it's being shepherded correctly, it's being used appropriately to get the most bang for their buck. And so as people who have been through it before and done it, they want to make sure that they're able to leverage their experiences to help the founders avoid any of the mistakes they've made in the past.
Mm-hmm. Okay, thank you.
So going on, talking about, digging a little bit into who are angels, and they're a little bit of everyone. They can be your friends and family, as long as they're accredited investors. They can be sophisticated or unsophisticated. They can be large investors. They can be small investors. As I said, the people on Shark Tank are angel investors, as are a bunch of people around CMU and around Pittsburgh in general. They can be passive or they can be active. For example, Blue Tree Allied Angels, it was known as a very active angel group. There are other people who are very passive, who invest and then let the founders kind of run the company as they see fit. They can be individuals. They can also be family offices. Family offices are families that have considerable assets that are investing into companies under the family name as opposed to under individual names. All of those types of people fall under what we call angels as opposed to venture capitalists. And the numbers of angels in the US have been growing significantly over the past 10 years. Over the past 3 years, so this goes up to 2013 on the slide and 2019 in our notes, this kind of trend continues. In the past 3 years, there's been a slight shift. The number of angels is increasing, but there are also a number of venture capital funds that are moving into the seed space that are helping fund these deals and provide some more liquid assets for these companies, as well as some more structure to how these deals are kind of structured and how the term sheets are written. So I talked about angels. Now I'm going to jump over to angel networks. So what are angel networks? Angel networks are groups of angels who get together and pool their money in different fashions in order to invest into companies together. The reason that this became popular over the past, say, 10 years was that in order to help the companies, investing $10,000 by itself isn't very useful and doesn't give the company an incentive to really leverage the angel's knowledge. And companies that take in a lot of angel capital end up with a lot of people that are all vying for their interests. So what angels started doing was starting to aggregate their money together into larger funds and then invest as one large group so that they were a more significant player on the cap table and they could get some benefit from the aggregation itself. They can work together to put larger amounts of money into the company. They can leverage who among their network is the best person to help this company address whichever problem that needs to be addressed at that time, and then step away as needed. They can also aggregate all of their connections, all of their networks, all of their things, both for deal flow as well as to help companies out. This allowed them to start to think about things like, how do you structure a portfolio? So rather than taking $10,000 and putting it into 3 different companies, they could aggregate their number and put it into 20 companies, thereby diversifying their risk and making sure that they're doing a better job of building a portfolio rather than trying to pick winners. And in this asset class, picking winners is really hard. No one knows what's going to happen. Having the best company and the best management team is no guarantee for success. For example, who knew that COVID was going to hit and how that was going to affect so many different companies? Global politics, so many things that are outside of the founder's control affect whether companies can succeed or not. So in view of that, in view of those huge amounts of risk, many angels know that you have to diversify your portfolio. The easiest way to do that is by aggregating your funds together and investing through a larger fund. So let's talk a little bit more about who are these angels, or who are really investing in early stage companies and why that's important. And so, I'll compare 2017 to 2019. What you'll see is angels and micro VCs are the largest investors for early stage companies. They're the ones that give companies the initial push to start working down and building a company so that they can get to the larger VCs down the road. And what you'll see in comparing these two slides is the number of deals that angels were doing in 2017 was very large and VCs was relatively small. 2019, the number actually went down for angels, but you'll see a huge jump in VC. A lot of angel funds started turning themselves more into micro VC funds. Same people putting their money behind 1 or 2 or 3 managers to manage which companies they're investing in. But in general, the same play. So now the question is okay, I've talked a lot about who are angels, what we do, where we invest, but why are we important? Why is this something that the SEC pays attention to? Why is this something that that we're talking to you guys about? Why is investing in early stage companies important at all? Here's the big thing that we want to show is that if you look at job growth in the US, if you take out companies that angels invested in, the job growth has not been great. But if you add those companies back in, job growth has been significant. This makes sense when you think about it. If you think about an early stage company, to triple the number of employees in an early stage company is relatively easy. If you have 3 employees, getting to 9 is easy. If you're Google, tripling your number of employees is an impossibility. It just doesn't work. So a lot of the larger companies can't increase their headcount as quickly and as easily as early stage companies can with the right amount of funding and funding the right people. The other thing to note is that angel investing happens all over the country and actually all over the world. What we are seeing is angel groups popping up all over the place to try to help companies grow in their backyards. As the companies grow, then you reach out to the VCs that are more centrally located in California or New York or Boston. But the early investments happen all over the country, and specifically in the Midwest, in the South, in the Northeast, places that don't typically see a lot of VC capital until later on. So unless anyone has any questions about angels in general, I'll talk a little bit about Bluetree, who we are as Bluetree Allied Angels, who we are as Bluetree VC. We have been for the past 18 years, a network of accredited investors, those high net worth individuals, anywhere between 50 and 78 individuals in any one of our funds, who are aggregating their money together to invest in 4 to 6 new companies every year, a total of 8 to 10 companies we invest in every year. A lot of our network, so we are more generalists. So ours are C-suite individuals from all different industries, cash out entrepreneurs, lawyers, professionals in general. People, so we are more of a generalist. We invest in a little bit of everything. We really focus not on being the technology advice or mentor for our companies, but more around corporate governance, more around how do you think about this the product you're developing? How do you think about the market you're attacking? How do you really build that out so that you can do the best you can possibly can and avoid some of the obstacles that we faced in our past? This is a little bit dated, but this was the last time CB Insights put this list out, but we are one of the top angel groups in the country, and we have been for a while. So what does it, when you're asking for money from an angel group, who are you asking money for and what are they doing? They're doing a few different things, and I'll start with the sourcing and screening. The first thing they're trying to do is find deal flow. Find the best companies to invest in, find a decent number of companies so that they can look at them, compare them to each other, figure out who they want to invest in and move forward. That leads into the diligence. Once they've got a good set of deals coming in, think about all the companies here in the Schwartz Center, think about the companies around. How do they decide which companies are best? And here, the real question is, which companies are best for them? Just because a company receives investment from an angel group or doesn't say so much about the company, but does say a lot about the relationship between the company and that angel. Angels typically want to invest money where they can add value beyond just the capital. They want to provide advice, they want to provide mentorship. And that's the way that they leverage their capital in order to grow it as efficiently as possible. As the due diligence process goes, eventually there's the question about what does this deal look like? What's the pre-money valuation? How much money is being raised? What's the board structure? What's the option pool? What are the different rights that are being given to different people? That negotiation happens for a lot of different reasons, but it's one of the first times that the entrepreneur and the angel really get to work with each other and get to know each other beyond just one side pitching to the other, more as a partnership, more as a team. So that deal structure and negotiation is really an important step in building that relationship. And finally, after the investment is made, then angels stick with the companies all the way till exit. So we don't get our money back until the company is sold. So we are there trying to help our companies out throughout the process.
I have a question. What is the kind of range of duration, for Bluetree, from the time of engagement to closing this angel round?
So unlike venture funds, we are not structured where we have an end date that must be hit. So we aim for an engagement lifespan of about 5 to 7 years. We've had companies exit in as little as 2 or 3 years from our first investment. We've had companies in our portfolio for up to 14 years at this point. So, but the aim is to have our companies grow for the next 5 to 7 years and then reach an exit point.
Yeah, sorry, maybe I didn't make it clear. What I mean is the engagement to a new company and when you close that angel round. Sorry,
yes, on the diligence side. So we are a relatively slow company. So our diligence process is typically 6 weeks to 3 months, depending on how prepared the company is for diligence. So for us, there are 6 key areas that we dig into. The management team, obviously, the structure of the round and the structure of the company, the product and the market, the financials, the barriers to entry to make sure no one can copy it, and then the exit analysis. We dig into each of those pretty deeply. It takes us a pretty decent amount of time. 6 weeks is actually pretty fast for us. But 6 weeks to 3 months is our engagement process.
Thank you.
And following up on that, there's a lot of different things that happen. So there's the deal flow and screening committee. So deal flow committee looks at every deal we see every week and tries to determine whether or not they meet our minimum criteria. Screening committee meets once a month to look at the ones that were best, the best companies we saw that month, to see if any should move into diligence. The due diligence committee, a lot of that happens here at Tepper, really start to dig in over that 6-week period or 3-month period to figure out if and what are the warts on the company, or if there are things we can accept and help, or if it's something that doesn't really fit our investors' abilities to really help the company move forward. After we invest, then we've got mentors and board reps that are sitting with the company, helping them grow. And we have a growth and transaction company that's really focused on our later stage companies, helping them think about, okay, now it's time to worry about exit, who's going to buy you, how do you get out of this? What is the next step down the road? So I'll talk about some of the things as the diligence process progresses that all angel funds look at and all angels in general look at. We want to know that the company is scalable. We want to know that even though it may not have revenue yet, or the revenue might be small right now, it can grow to a point where it's going to be generating a decent amount of revenue to make it an attractive acquisition target to a larger company. We want to know about high gross margins. That's important because if our capital is going in to help the company grow, we want to make sure that as they grow, they can start taking the capital that they're getting off of their product and reinvest it into building the company, not having to buy more product, not having to spend it really on the cogs of the company, but really focus on growing the company. We want to know that, if they can do these two things, that it's a large enough market that they can expand into and get to that $30 million size of revenue, and not kind of have to, own 100% of the market in order to do that. We want to know what their unfair competitive advantage is. We want to know what's special about them. Is it the team? Is it their personality? Is it their skill sets? Is it something about the product? Is it something that's patented or trade secret? What is it that's going to allow them to succeed where others fail? What is it that's going to make them attractive for someone to buy rather than just copy? This is often important for a lot of our entrepreneurs, is that in every round of funding, you should expect to give up between 20 and 30% of your company. That's just a typical rule of thumb. But basically, when investors come in from the first round on, every time they're going to ask for about 20 to 30% of the company, depending on how well you're doing and depending on how much money you need to get to the next inflection point. Sometimes less, sometimes more. But generally, most companies should expect to do that and do it multiple times throughout the course of the business growing. We've talked a lot about this, but again, management team is by far the most important thing for a company that we're going to invest in. Most specifically, making sure that the management team can execute to the goals that they've set up. Execution risk is the #1 risk for early stage companies, and so we want to mitigate that as much as possible as we're making our investments. All of that said, all of that diligence said, everything we've said to date, we still expect about a 50% failure rate on our companies. And of the 50% that don't fail, we still expect more than half of them not to get to that 10x return. We really make our money on the top 10 to 20% of our companies, really hitting it out of the park. Because as I said earlier, there's so many different ways that things can go wrong that have nothing to do with the founders. So even if you do the best diligence, even if you found the right product and the right founders, there's just a lot of risk in this asset class. And so we need to spread our risk over 20 companies, and we need to build a financial model that basically bakes in the fact that half our companies will fail. So how have angels done? And the impressive thing here is the size of that seed funds, the green bar. The thing to note about that is take it with a grain of salt. What's not shown on this graph is the variation, or the how well individuals funds did compared to that number. So if you think about seed funds, some have lost all their money. Some have done much better than that 22.4%. Whereas you think about the NASDAQ, if you're thinking about buying S&P 500 or whichever, that 13.2%, that's going to hold. Like you might go a little bit above that, a little bit below that, but in your public equities, if you're doing a an ETF, you should be able to know what you're seeing day in and day out. The variation is going to be very small around that. The other thing to note is that in the first 2 to 3 boxes there, the other thing you're giving up by investing is liquidity. Unlike in the public markets where I can buy and trade on a daily basis, once you put your money in, it's in. There's no way to pull it back out until you get to an exit. So not only is there a lot of variation, but there's no liquidity at all for what we do. That's why we have to do so much diligence. Diligence is what lets us kind of make those educated bets. And for funds that don't do the diligence, they've been shown, as the slide says, to really have negative, not negative returns, but not as great returns. You need to know what you're investing in and why you're investing in it in order to kind of get the type of returns that you need to see in order to justify putting your money into this asset class rather than, say, the public markets. And so I'm going to close here and ask for any other questions, but Catherine, my boss or partner now, often likes to close with this slide, which is, yes, making the investment should be easy, find the right companies, but finding the right companies means answering a question like this and getting all of the different pieces in blue correct, which is very, very difficult. And as much diligence as we do, a lot of it is luck as well as it is skill. And so that's what angels are. That's who angels are. That's how they invest. I'd be happy to take any questions that anyone has.
Hi,
I have a
Sreekar.
question.
Oh.
You can go ahead.
Oh, thanks. Hi, Sreekar. This is Aaron Remerenko. I'm a Tepper grad. And I had a question. Actually about, I think it's the safe investing structure that Y Combinator has sort of started to proselytize,
Yes.
where it's kind of the standardized, I believe it's a convertible note structure. And just kind of interested in your thoughts on that. And do you see that being, sort of something that's, sort of should be a standard, should be common, and sort of other things that maybe we should consider if we're thinking about using that as a structure?
So I will say, so we absolutely will not invest in a safe, and many VCs or angel groups have that same rule, but not all, and not even a majority. The issue here is, what's the difference between a safe and a convertible note? They're basically used interchangeably. The difference is if something goes wrong with a convertible note, it's a debt instrument, which means you do have certain rights as an investor to get some return on your investment. A safe is not a debt instrument, which means if things don't go wrong, there's no protection for the investor in that asset.
Gotcha.
On
So
the flip side,
go ahead.
Oh, so the counter argument to that is none of us are investing for things to go wrong. So hopefully that doesn't come to play.
Right. But it sounds like maybe perhaps if sort of if we're looking for funding for our startup, it's kind of like if we can do the safe, it might be beneficial for us, but from the investor side, clearly not as beneficial because you don't have that same recourse.
That's correct. And now that convertible notes have pretty standard terms, the idea of the safe was it was supposed to be very simple. There wasn't a lot of legal paperwork. You should be able to get it done quickly. Now that most convertible notes follow almost the identical structure, it shouldn't be that much more expensive to get a convertible note round done compared to a safe round.
Gotcha. Excellent. Thanks. That's really helpful.
You're welcome. I have a question here in the room.
Yeah, I noticed that in some of your slides, the data was from 2007, like the last one. So my question was kind of, a lot has changed since then. In 2007, 2008, Alpha Lab was just getting started. Now we have 3 different Alpha Labs, and that's just locally. But are there any recent stats that you've seen that kind of denote that change within the field? Within the last 5 years that either make you hopeful or sour in the mouth?
We don't have any statistics, so I'm going to speak about anecdotally what we're seeing.
Yeah.
So the last 5 years, things have been pretty steady. I'd say the last 2 years, we're seeing a big change. And the big change has been, there's now a lot more opportunity for crowdfunding. So there's multiple crowdfunding sources out there. There's also a lot more angel groups that are appearing. So angels themselves, a lot more people are getting involved in this asset class. There was and still is for the moment, a lot of excess capital out there that's being put into early stage companies. That's been both a good thing and a bad thing for us. And so here's where it plays in the 2 different ways. It has been great to see a lot of entrepreneurs be able to get funding. There's been 2 side effects of that. One is there's been less diligence. So a lot of the earlier stage companies that are getting funding haven't been as diligent as in the past. So companies that would have not gotten to the stage or had to reimagine themselves before they could get funding haven't had to do that yet. And sometimes that leads to some burn of capital before they figure out what they really are. The other thing is we're seeing a lot of, and especially in crowdfunding, we're seeing a lot of investment without the protections of someone providing mentorship guidance that comes along with that investment. That makes it difficult for the entrepreneur because you're kind of going it alone. You're getting the money you need, but without all the help that really allows you to use that money as effectively as possible. And what that causes down the road is you've taken on money in one form or another, and in some way or another, you've given up equity. And if you haven't built up the value to justify that money you've taken on and really structure that round correctly, you may not be able to get the valuation you want on the next round, which makes things a little bit more difficult down the road. Added to the fact that your cap table, the table that lists out who owns what pieces of your company, gets to be very complicated. And as it gets more and more complicated, as more and more people get on there, it gets harder for later investors to get comfortable putting more money into a company. So there's a good and a bad. It's great to see all these companies get funding. Right now, if you're raising $500,000 to $1.5 million round, there's a lot of funding sources out there. It's not easy, but it's not as difficult as it once was. But that comes with some caveats. Any other questions?
Yeah, I had a question. So I know you heavily emphasize the management team experience as something you prioritize. How would you say you look at that for a team of recent grads? I know a lot of us at CMU are trying to do that. This may be our first venture. How do we show credibility in that aspect?
It's not management team experience, it's the management team itself. So what we look for is, do you have something in your background that allows you insight to the industry that you're building a product for? Were you an employee in that industry? Do you have connections to that industry? Do you know that industry well, such that what you're hypothesizing as a need of the industry has some validation behind it, because we won't know the industry ourselves. Do you have the grit, the personality to really fight through what's going to be a very, very difficult process? Anyone who says being an entrepreneur is easy hasn't done it yet. It's very difficult. We really admire the entrepreneurs in our network. And what we want to make sure is that, in going to your question, what you want to show is that you and your team have that tenacity to really continue working at a product, especially when people tell you no, or it's crazy, or you're going to fail. We want to be able to invest in people that are going to be able to get past that and use that to really be something that motivates them to succeed even more.
Okay, that makes sense. And I have another question if no one else does. When we approach angels, is there an expectation of the amount of self money that we've put in, or friends and family money before we can approach, or there is we can approach it at any duration in our life cycle?
Yeah, I would say that there's no expectation about how that's structured, with the caveat that if you have taken in money, you know how that money, you know the terms of how that money's come in. So what takes us some time when we're doing diligence, if someone comes to us and they say, you know, we self-funded this, or our friends and family, provide us capital, but they never actually looked at the terms of the earlier rounds, or they never really paid attention to how that math was all structured out. And we have to kind of go back and figure out what all of that capital means to ownership stakes in the company. But no, there's no expectation that money has been already raised or that it hasn't been raised. Just that the company is at a place where the money we're putting in can really propel it to the next stage.
Okay, got it. Thank you.
Hi, I have a question.
Go ahead.
Thanks. So I'm Ellie. I'm the founder and CEO of Behavior, and we have received a decent amount of funding, primarily through grants, but some through investment. But when we've been trying to find additional funding, we've come across these barriers where almost everyone that we reach out to is expecting us to have a significant ARR. And so we're just wondering how do we find the folks who are investing in companies that aren't at that place? We just recently commercialized, and so we don't have millions in revenue. But everyone that we're finding and talking to, and everyone who's been interested in meeting with us is saying that. So we're wondering if somehow we got into these deal flows that are for companies that are further along, and we've been having trouble finding those folks. Do you have any recommendations for how to find the right people who are like, oh, cool, you have this amazing product. I understand you don't have millions in revenue yet. So yeah.
Yeah, so generically, I would answer that as saying, you want to talk to angels or angel groups. More specifically, I would say it depends on how you're positioning your company. If you're positioning the company as a company that's proven the product in market and is now ready to scale, then your investors are thinking, if that's true, then show me that people are buying the product. That's why they're asking you about ARR. They want validation that people are buying the product. If you're positioning the company as, we've got an MVP, we've got a product in market, and we're testing it out, and we're now going to harden our supply chain, harden our product, make it scalable, then ARR doesn't become as much of an issue. So I think my answer would be, it might be in how you're positioning the company. You might be positioning it a little bit more mature than it might be yet, and that might be causing people to ask you, tell me about the ARR.
Okay, that's helpful. Thank you.
Are there any other questions? If not, then thank you everyone. Thank you all for listening to me, and I hope it was helpful.